In 2025, one of the smartest places to put your money is in assets that have both scarcity and lasting demand. Real estate in growth-driven regions, agricultural land, and even certain commodities fit this category. These assets don't just preserve purchasing power, they thrive in environments where inflation and currency fluctuations erode cash savings. They provide both security and potential appreciation because the world will always need shelter, food, and raw materials. When we think about building wealth for the long term, we have to start by grounding ourselves in the basics of what makes an asset truly valuable. It's not about speculation, and it's not about chasing the latest fad that everyone is talking about. The truth is, lasting wealth comes from owning things that hold their value through time, things that can't simply be created out of thin air, and things that the world fundamentally needs. That's why real assets with scarcity and utility form the bedrock of any long-term strategy. They are the foundation you build on before you take on more risk, because they give you something solid in a world that is constantly shifting. Consider real estate. When you strip away all the noise, the essence of real estate is simple, land is finite, and people will always need a place to live, work, and operate businesses. Population growth, urbanization, and economic development continue to drive demand for quality real estate in the right location. If you choose carefully, focusing on regions where jobs are growing, infrastructure is improving, and demographics are favorable, you're not just buying a piece of land or a building, you're securing a claim on a resource that is both limited and essential. The key is to see beyond short-term market fluctuations and understand the structural forces that create enduring demand. But it's not just housing or commercial property. Agricultural land, for example, is one of the most overlooked but powerful real assets. The world population is rising, diets are shifting, and the demand for food is increasing. Yet the amount of arable land is shrinking due to urban sprawl, soil degradation, and climate pressures. Owning agricultural land in the right regions is like owning a piece of the food supply chain itself. It produces cash flow through crops and leasing, and it appreciates as the world comes to grips with the reality that food security is a pressing issue. These are the kinds of assets that quietly compound value while other markets swing up and down. Commodities also fall into this category. Oil, natural gas, copper, lithium, and rare earth elements are not just tradable contracts on a screen, they are the building blocks of modern life. Without them, there are no electric vehicles, no smartphones, no infrastructure projects, and no industrial growth. They are scarce, and their extraction is expensive and time-consuming. When you hold exposure to commodities, whether directly or through well-managed producers, you align yourself with assets that the global economy cannot function without. Their prices may be volatile in the short term, but over the long run, they tend to rise with demand and with the erosion of fiat currency purchasing power. The other important part of this conversation is understanding why scarcity and utility matter more than anything else. In a world where central banks can print trillions of dollars in a matter of months, what's the one thing they cannot print? Land, food, minerals, and energy. They are outside the control of policymakers and politicians. They obey the laws of supply and demand, not the whims of government budgets. When currencies lose credibility, when debt becomes unsustainable, when inflation erodes savings, these assets remain resilient. They don't just sit there as numbers on a screen, they produce shelter, sustenance, energy, and industrial capability. Now, none of this is to say that every piece of real estate or every commodity investment is automatically a good one. Timing, location, and price all matter. If you buy at the peak of a bubble, or you choose a property in a declining region, or you bet on a commodity without understanding the supply chain, you can get burned. The lesson here is not blind faith, but disciplined selection. You have to be a student of cycles, understand how interest rates affect property values, how climate change might impact agricultural yields, and how technological shifts might reshape commodity demand. For example, lithium demand is exploding because of electric vehicles, but lithium supply is also ramping up as new projects come online. If you don't understand the balance, you risk being caught on the wrong side. The other thing to keep in mind is that real assets, while resilient, often require patience. They don't move as fast as speculative investments, and that's actually their strength. They give you stability, they compound quietly, and they allow you to weather storms that wipe out weaker hands. If you think in decades rather than months, you start to see how powerful this can be. That apartment building you buy in 2025 might not double in value overnight, but 20 years down the line, it's generating steady rental income, it has appreciated substantially, and it has protected you against inflation the entire time. There's also a psychological component here. When you own real assets, you can see them, touch them, and use them. That gives you a different relationship to your wealth compared to paper or digital claims that can vanish in a financial crisis. It grounds you. It reminds you that wealth is not just about numbers, it's about control of real resources. And when times get tough, it's those real resources that matter most. So the question becomes, how do you integrate real assets with scarcity and utility into your overall portfolio? The answer is balance. You don't want to be overexposed to a single type of asset, but you also don't want to ignore this category altogether. A well-balanced portfolio in 2025 should include a healthy allocation to real estate in strategic regions, exposure to agricultural land, if possible, and a mix of commodities or commodity-linked investments. This combination anchors your wealth in things the world cannot live without, regardless of what happens in financial markets. As we move into 2025, the global economy is going through transformations, monetary shifts, geopolitical rivalries, technological disruption, and climate challenges. All of these factors create uncertainty, but through all of that, people will still need homes, food, energy, and raw materials. By anchoring your wealth in these essentials, you position yourself to survive the storms and participate in the growth that comes after. You're not just playing defense, you're building a foundation for compounding wealth that can last generations. In the end, the principle is simple: own what is scarce, own what is useful, and own what cannot be replaced. That's how you move beyond speculation and toward true wealth building. Everything else flows from that. When you think about investing for the long term, equities are one of the most powerful tools you can use, but it's important to approach them with clarity, discipline, and an understanding of what drives their value. Stocks are not just tickers that move up and down on a screen. They represent ownership in businesses that are solving problems, creating products, and delivering services that people around the world rely on. The wealth that equities generate over decades comes from the growth and productivity of those underlying businesses, not from speculation on short-term price movements. The key is to identify which companies and sectors are positioned to thrive in the years ahead and to align yourself with them for the long haul. If we look at where the world is headed in 2025 and beyond, the forces shaping our future are clear. We are in the middle of technological revolutions, demographic transitions, and geopolitical shifts that will create both risks and opportunities. Some sectors will stagnate or decline, while others will grow faster than most people can imagine. The investors who recognize these shifts early and commit to them patiently will be the ones who build enduring wealth. Healthcare is another area where long-term growth is undeniable. As populations age in developed countries and access to healthcare expands in emerging markets, the demand for medical services, biotechnology, and pharmaceuticals will continue to climb. Beyond demographics, breakthroughs in genomics, personalized medicine, and biotechnology are opening doors to treatments that were once unimaginable. These are not temporary trends. They are long-term shifts in how humans approach health and longevity. Companies at the forefront of these changes will not only create enormous financial value, but also improve millions of lives. Energy is in transition, and this is another sector investors must pay attention to. The world is shifting away from traditional fossil fuels toward renewables, but that transition won't happen overnight. For decades to come, the world will still need oil and natural gas, but alongside that, there will be explosive growth in solar, wind, battery technology, and the infrastructure required to make renewables reliable at scale. Companies that are building the technologies to store, distribute, and efficiently use energy will be central to this transformation. If you think about wealth building as aligning yourself with inevitable trends, then energy transition is one of the most important investment themes of our time. Another overlooked but critical sector is digital infrastructure. The internet has become the backbone of global commerce, communication, and culture. Yet what most people don't see is the physical and technological infrastructure that supports it: data centers, fiber optic networks, satellites, and cybersecurity. As more of the world comes online and digital demand multiplies, these companies become the toll roads of the digital economy. Investing in digital infrastructure is like investing in the railroads or highways of the past. Once built, they carry economic activity for decades and create steady compounding returns. But it's not enough to simply identify these sectors. The way you approach equities matters just as much as the sectors you choose. Many investors fall into the trap of trying to time the market, chasing hot stocks, or panicking during downturns. That is a losing game because it is rooted in emotions, not in principles. The way to build lasting wealth through equities is to think like an owner. You are not buying a piece of paper, you are buying a share of a business. If the business is well run, has strong competitive advantages, and is positioned in a growing market, then the daily volatility of its stock price is irrelevant. What matters is that over time, its earnings and productivity will grow, and your share of that growth will compound. One of the most powerful forces in investing is compounding. If you invest in equities that grow steadily year after year and you reinvest dividends, your wealth doesn't just grow, it accelerates. A company that compounds earnings at 10% annually may not look exciting in a single year, but over 20 or 30 years, the effect is staggering. This is why patience is so critical. Equities reward those who think in decades, not those who trade on headlines. Another point to recognize is that equities also provide protection against inflation. Businesses that produce goods and services people need can raise prices as costs rise and their earnings grow in nominal terms. Over time, this allows equities to preserve and increase purchasing power, while cash sitting in a bank account gets eroded by inflation. If you're looking to build long-term wealth, equities are not just an opportunity, they are a necessity. Of course, risks exist. Not every company in a growing sector will succeed. Innovation brings competition, regulation, and disruption. That's why diversification is essential. By spreading investments across multiple companies, industries, and even geographies, you reduce the risk of being blindsided by a single failure while still participating in overall growth trends. Diversification is not about diluting returns, it's about ensuring that your wealth is resilient in the face of uncertainty. It's also critical to keep perspective. Markets will always move in cycles. There will be booms when valuations run too high, and there will be busts when fear drives prices too low. These cycles are not to be feared, but to be understood. If you maintain a long-term mindset, downturns are not disasters. They are opportunities to buy ownership in great businesses at discounted prices. The biggest mistake most investors make is letting short-term fear push them out of long-term opportunities. When you put all of this together, equities in innovation and resilient sectors become a cornerstone of wealth building in 2025 and beyond. They are not perfect, and they come with volatility, but that volatility is the price you pay for growth. If you understand the cycles, focus on fundamentals, diversify intelligently, and stay patient, equities will reward you more than almost any other asset class. At the end of the day, wealth is built by aligning yourself with the most productive parts of the economy. Equities are your bridge to that productivity. They give you access to the creativity, innovation, and problem-solving capacity of the world's best businesses. And if you hold them with discipline, they will create wealth, not just for you, but for generations to come. When you're thinking about long-term wealth, one of the most important things to remember is that protecting what you already have is just as critical as growing it. Too many people focus only on chasing returns, But real wealth builders understand the role of defense. That's where precious metals and store of value assets come in. They are not designed to generate the highest returns in the short term, but they play a unique role. They preserve wealth when the rest of the system is unstable. They act as insurance, and in a world full of debt, money printing, and geopolitical uncertainty, that insurance is not optional. It's essential. Take gold, for example. For thousands of years, across every culture, it has been trusted as money and as a store of value. Empires have risen and fallen, currencies have come and gone, but gold has remained. The reason is simple: it cannot be printed, its supply grows very slowly, and it is universally recognized. When people lose confidence in paper currencies, they turn to gold. It doesn't rely on the creditworthiness of a government or a bank. Its value comes from its scarcity and its history. That makes it an anchor in times of crisis. Silver plays a similar but slightly different role. While it has also been used as money historically, silver has a strong industrial demand component as well. It is used in electronics, solar panels, and various technologies. That dual role, store of value and industrial necessity, gives silver an added dimension. It tends to be more volatile than gold, but it also has explosive potential in the right environment. Holding both metals gives you balance: gold for stability, silver for growth potential. In the modern era, digital assets like Bitcoin have entered the conversation as store of value assets. Bitcoin is unique because it combines scarcity with technology. There will only ever be 21 million coins, and that supply is hard coded. Unlike traditional money, no central authority can inflate it. That makes it appealing in an age where trust in governments and currencies is weakening. While it is young compared to gold, it is gaining recognition as a digital alternative, a kind of digital gold for the 21st century. For investors, it represents both an opportunity for asymmetric returns and a hedge against the risks of fiat currency debasement. But why exactly do these store of value assets matter in a portfolio? To answer that, you have to step back and look at the bigger picture. The global economy runs on credit and debt. Governments borrow to fund spending, central banks manage currencies through monetary policy, and businesses and households rely on borrowing to grow. This system works until it doesn't, until debts become too large, currencies lose credibility, or geopolitical events disrupt the balance. When that happens, the value of paper wealth can evaporate very quickly. Stocks can crash, real estate can collapse, and currencies can be devalued overnight. That's when assets like gold, silver, and Bitcoin reveal their true purpose. They don't depend on anyone's promise to pay. They are not tied to the solvency of governments or banks. They are neutral stores of value that exist outside the system. It's important to recognize that holding these assets is not about betting on disaster. It's about acknowledging that the future is uncertain and that cycles always play out. History is full of examples where people who relied only on paper wealth were wiped out when systems reset. But those who held some portion of their wealth in hard assets came through those periods intact. That's the function of these stores of value. They give you resilience. At the same time, it's worth being realistic about their limitations. Gold and silver don't pay dividends. They don't produce cash flow like a business or a piece of real estate. Bitcoin doesn't generate earnings. These assets are not meant to replace growth-oriented investments. Instead, they complement them. They are the ballast in the ship, the stabilizer that keeps you upright when the seas are rough. If you put all your wealth into them, you miss out on growth. If you ignore them entirely, you leave yourself exposed. Balance is the principle that matters. The question then becomes, how much should you allocate to these assets? The answer depends on your goals, your risk tolerance, and your view of the world. Some investors hold 5–10% of their wealth in gold and silver as insurance. Others who are more cautious or more distrustful of fiat currencies may allocate more. With digital assets like Bitcoin, because of their volatility, it often makes sense to start small, perhaps 1 to 5%, and let compounding work if the asset succeeds over time. The key is to think of these allocations as protection, not speculation. You don't need them to skyrocket to make them valuable. Their very presence in your portfolio is what gives you strength. Another layer to think about is accessibility and liquidity. Gold and silver can be held physically in the form of coins or bars, or through exchange traded funds and mining companies. Each has its pros and cons. Physical ownership gives you direct control, but requires secure storage. Paper instruments are more liquid but carry counterparty risk. With Bitcoin, custody becomes the main issue. Do you hold it yourself, with all the responsibility that entails, or do you rely on trusted custodians? These are practical decisions that determine not just returns, but security. It's also important to think globally. Many investors are anchored in their home country's currency, often believing it will always remain strong. But history shows that no currency has held dominance forever. The US dollar has been the world's reserve currency for decades, but even it faces pressures from rising debt deficits and global competition. In such an environment, owning neutral stores of value is a hedge against the possibility that your home currency weakens. It's not about predicting collapse, it's about preparing for the full range of possibility. One of the mistakes people often make is dismissing these assets during times of stability. When markets are rising, when inflation is low, when currencies are strong, gold and silver seem unnecessary, even outdated. But that is precisely when you should accumulate them. By the time a crisis makes their importance obvious, it's too late. Their prices will already have surged and access may be difficult. Building wealth requires foresight, not reaction. You prepare before the storm, not during it. Over the long term, what matters most is not just how much money you make, but how much you keep. Precious metals and store of value assets are about ensuring that wealth is preserved through cycles, through crises, through the unpredictable forces of history. They may not give you the thrill of rapid gains, but they give you something more important, confidence that no matter what happens in the world, a portion of your wealth is secure. That psychological stability is worth as much as the financial returns themselves, because it allows you to stay disciplined in the rest of your investment. So when you think about 2025 and beyond, don't just focus on the assets that promise the highest growth. Think also about the assets that give you resilience. Gold, silver, and Bitcoin may not always be exciting, but they are timeless tools for anyone who is serious about long-term wealth. They are the anchors that hold your financial ship steady in turbulent waters, ensuring that you don't just accumulate wealth, but that you keep it when it matters most. When you step back and look at the big picture of wealth building, one truth becomes clear. No single asset class will carry you safely and profitably through every environment. Markets move in cycles, economies evolve, and risks emerge where you least expect them. That's why diversification isn't just a strategy, it's a necessity. And one of the most overlooked but powerful areas of diversification comes from alternative investments. These are the assets that don't always move with traditional stocks and bonds, and because of that, they can provide both resilience and unique upside in a well-constructed portfolio. Alternative investments cover a wide range. They include private equity, venture capital, hedge funds, art, collectibles, real estate beyond the traditional residential sector, and even fractional ownership in rare assets. The unifying principle behind them is that they are outside the standard public markets, which means their performance is often less correlated with the daily ups and downs of stocks and bonds. This makes them valuable not only for their potential returns, but also for the stability they can provide when traditional markets falter. Take private equity, for example. When you invest in private equity, you're essentially backing companies before they go public, supporting them during their growth phases. These are businesses that may not yet be on the radar of Wall Street, but they have strong potential. Private equity firms often take an active role in guiding these companies, improving operations, and positioning them for long-term success. Venture capital takes this even further, focusing on early-stage companies, often in technology, healthcare, or other innovative fields. Investing here is like planting seeds in fertile soil. Many won't grow, but the few that do can grow into giants. The challenge is that these investments require patience and an acceptance of uncertainty, but the payoff from just one successful investment can more than offset the failures. For long-term wealth building, allocating a small portion to venture capital can provide exposure to the next wave of transformative businesses. Hedge funds and other alternative strategies are another layer. These funds often use tools that individual investors can't, short selling, leverage, derivatives, to create returns that don't depend on markets always moving upward. Then there are tangible alternative assets like art, collectibles, and rare items. At first glance, they may seem frivolous, but history shows otherwise. Art has preserved and grown wealth for centuries. Rare wines, classic cars, vintage watches, and even collectibles like rare stamps or trading cards have all appreciated significantly over time. The reason is simple: scarcity. There is a finite supply of these items, and as wealth grows globally, more people want to own them. That demand drives values higher. While these markets can be less liquid and harder to access, they provide another form of diversification, one tied to cultural value and scarcity rather than financial engineering. Another promising area of alternatives is infrastructure. Owning stakes in toll roads, airports, shipping ports, and renewable energy projects can provide steady inflation-linked cash flows. These assets are essential for societies to function, and they often come with long-term contracts that generate predictable returns. In uncertain times, that stability is incredibly valuable. Infrastructure investments often sit between traditional real estate and private equity, offering both tangible security and attractive yields. Fractional ownership is also changing the landscape. Today, investors don't need to buy an entire office building, a piece of farmland, or a Picasso painting to gain exposure. Technology has enabled fractional ownership platforms that let individuals own small shares of large, traditionally inaccessible assets. This democratization of alternative means that more investors can diversify into these areas without needing massive amounts of capital. What ties all of these alternatives together is the idea that they allow you to build a portfolio that doesn't rely solely on the performance of public stock markets. In a world where uncertainty is constant, whether it's inflation, political risk, or financial crises, having exposure to assets that move differently gives you resilience. When stocks are falling, your infrastructure investments might still be paying steady dividends. When bonds are under pressure from rising interest rates, your art collection or private equity holdings might be appreciating. Of course, it's important to acknowledge that alternative investments come with challenges. They can be less liquid, meaning you can't always sell them quickly. They often require more expertise and due diligence because valuations are less transparent. Fees can be higher, and because they are less regulated, they can carry risks that aren't always obvious at first glance. This is why alternatives should be approached carefully, with discipline and as part of a broader strategy rather than as a substitute for the basics. The deeper point here is that building long-term wealth is not about betting everything on a single idea or asset. It's about recognizing the uncertainty of the future and positioning yourself to survive and thrive no matter what happens. Alternatives play a critical role in that because they open the door to opportunities and protections that traditional markets alone cannot provide. As you think about 2025 and beyond, remember that the financial system is becoming more complex, competition for returns is increasing, and risks are shifting in ways that aren't always visible. Alternative investments allow you to adapt to that reality. They make your portfolio not just a collection of assets, but a resilient ecosystem. And in the end, that resilience is what gives you the confidence to hold through cycles, stay disciplined, and let compounding do its work. So the principle is clear: diversify beyond the obvious. Don't ignore the power of alternatives simply because they require more effort or because they're not as familiar. The investors who build true, lasting wealth are those who understand that the world is bigger than stocks and bonds. By embracing alternative investments carefully, thoughtfully, and in balance, you give yourself the chance to not only preserve your wealth, but to grow it in ways that others will overlook. That's how you build wealth that lasts, wealth that withstands storms, and wealth that endures across generations.